All right. So here is our guide. Here's what we're going to be going over in the next hour or so. We're going to start off with a home buyer roadmap, which is going to pretty much outline 12 steps to get you through the process. 12 milestones to look out for and kind of what to expect within each one of them. We'll take a look at a pre-approval versus a pre-qualification. These terms are used interchangeably quite often, although there is a significant difference between the two. We're going to take a look at who's involved in the process. Many times your main point of contact may be your loan officer or their processor, but it's important to realize and remember how many people are working on this file and how many people have to come together in order to push it through to the end. So we're going to take a look at that. We're going to take a look at, some tips for a simple loan approval. What's the best way to make this job easier for everybody that's involved? The easier that we can make it for everybody that's working behind the scenes, the quicker we can get this through the pipeline. Take a look at needed documentation. So obviously this is going to be different for everybody, but we'll go through a standard list that everybody's going to be asked for. And then depending on what is on those list of documents, it may spur more questions and it may spur the need for additional documentation. But we'll start at, the beginning, and then we can dive into other scenarios down the road. A home inspection versus a home appraisal. I get this question quite often, so we're going to dive into the differences there. We'll take a look at what's in a mortgage payment. I'm cutting a check every month to the lender, but what exactly is it for? So we'll go over all that. We're going to take a look at closing costs, kind of what to expect, who you'll be paying, who pays what, that kind of stuff. And then we'll take a look at the loan programs that are out there. So there's a lot of exciting stuff in that world. So we'll go through that as well. And then obviously questions and answers. So without further ado, let's move on. All right. So your home buyer roadmap. Let's get into it a little bit. I'd love to tell you it's a simple 3-step process, but if I did that, I'd obviously been lying to you. Um, I've narrowed it down to 12 steps, 12 milestones that you can look forward to along the process that will help outline our path to the finish line. So steps 1 and 2 are kind of interchangeable. Some people are going to go get pre-approved first and then find a realtor. Some people are going to find a realtor first and then get a referral to a lender to get pre-approved. In either case, these are both very important steps of the process. You want to take care of these before you start looking for a house. Obviously, that's going to be the next step. Once you find out what you're pre-approved for, you've got a realtor that you've teamed up with. And now the fun part starts. You get to go out and find your house. This is where you'll get with your realtor, schedule showings, check out the house, be sure to be clear, with your realtor on your expectations, your goals, your budget, all that kind of stuff. And get out there and find the house of your dreams. Once you're able to locate that, obviously the next step is going to be to make an offer. Again, you're going to work with your realtor on this and set the terms of the offer, the price, closing date, earnest money, maybe any special conditions. And you'll likely go back and forth with the seller a little bit in negotiating. But hopefully the end of that negotiation results in an offer that's been accepted, which basically will, hold this house for you through closing. Once you have that offer accepted, you've worked with your realtor up till this point. Now you're going to jump over and you're going to start to work with the lender. After that offer is accepted, you'll choose your closing and title company with your realtor. She'll go ahead or they'll go ahead and open up title and escrow once that offer has been accepted. After that's happened, you're going to want to get back with your loan officer and you're going to go have your sign your initial disclosure package. So this is just all the terms of the loan, the rate, loan amount, down payment, interest rate, all the hard numbers in black and white. Once we get that done at the same time, you're going to want to order your home inspection. So get with your realtor or anybody that you know as far as who can refer you to a licensed home inspector so they can get everything checked out for you. At the same time, once those initial disclosures get back and you've signed them and we have the intent to proceed, which is within that initial disclosure package, we can go ahead and order the appraisal. Now, this is the one thing that does have an upfront out-of-pocket cost, so you will be asked to pay for that outside of closing. And this is all done through an appraisal management company, so we really don't have much control over this process. But once we get everything together, maybe minus the appraisal because it's taken a couple weeks to get back, but we will submit it to underwriting. And this is really where we go under the microscope, so to speak, as far as verifying all the information that we've put on that application. So we've got to back everything up with W-2s, pay stubs, bank statements, whatever documentation is going to be required, and get it in front of the underwriter and make sure that they can check off the boxes as far as what we need to get it approved. Typically that process looks something like, you get the file submitted to underwriting, maybe 48 hours later you'll get a conditional approval. A lot of those conditions that are listed are just going to be processing stuff. There may be a handful of items that are going to be required, asked of the borrower. So we'll gather those up, get them back into the underwriter, and once we fight our way through that process, we'll end up getting our clear to close, which will allow us to send out our final closing disclosures. Now, the final closing disclosures is pretty much the final version of your initial disclosures. So it's a final rate, payment, loan amount, everything down to the penny. And then once you sign those, there's a 3-day waiting period until you can actually close. So typically you'll get your closing disclosures via email. You can sign them on your phone, and then we can get closing scheduled for 3 days after that at the title company. A couple different ways to do the final signing. You can do a hybrid signing, um, where you'll sign half of your documents electronically, the other half, at the table, at the closing table in the title company. Or you can sign them all there. It's whatever is easiest for you. So again, 3 days after that final closing disclosure goes out, we schedule the closing, and then typically funding will happen the day after that. There are certain circumstances in which we'll need to do, a same day funding, which is fine. Just need to know ahead of time in situations like that. We usually do. But this is the roadmap. We're going to dive into a lot of these items a little bit deeper here later on. But these are 12 milestones that will kind of guide you through the process and what to expect and what's going on. There's obviously a lot going on behind the scenes within and in between each one of these steps, but a lot of that's for your loan officer to worry about. His job's to keep you off the roller coaster, so to speak. So that is the roadmap, and now we will move on ahead. So now that we know what the process looks like, what those milestones are, let's take a look at who's involved in this process. A lot of times your main point of contact is going to be the loan originator, maybe a processor, an assistant, but typically you're only going to speak with one or two people throughout this process as far as how your loan is going. It's important to remember that there is a team of people working behind the scenes to push your loan through to the end. Those people, a couple of them obviously are going to be the buyer's agent and the seller's agent. Buyer's agent's going to negotiate the terms and the purchase price and wrap the contract, on your behalf. Seller's agent is obviously representing the seller and has their best interests at heart. You have title and escrow who are going to be involved as far as getting everything reconciled down to the penny when we get down towards closing, getting any title issues cleared, getting the closing scheduled. So they're a big part of this process. You're going to have your home inspector. Hopefully you have somebody that can refer somebody that is, has integrity, is good at his job. Because a home inspection is very important. That's where they're going to get underneath the house. They're going to crawl around in the roof. They're going to check every nook and cranny, and you're going to know everything about that house when that report is all completed. So that's a very important step of the process, as is the appraisal. The appraiser is going to go out and he's going to determine the value of the property. Got your insurance agent. We're going to work with them in getting the binder over when we get towards closing, providing an insurance quote to help establish the debt to income ratio, all that kind of stuff. You got your processor, you got a loan officer assistant working behind the scene and side by side with your loan originator to get everything in order and present it to the underwriter, which just happens to be the next person that pops up, probably the most important person in the process. Our job, my job, is to make their job simple. So that's all. A lot of times, as far as getting files through quickly and smoothly, it 100% comes down to how you present everything to the underwriter. You're clear, you're concise, you can document everything, and you just make their job very simple. They've got check boxes to check off, and if you can help them do that, the smoother your loan will go, and we'll move on to closing and funding. You got some more people involved at that part of the process. So, there's a lot of people working behind the scenes with your loan officer and with, the lender directly. And your loan officer's in the middle of all of it. He's playing quarterback, so to speak, and managing all these relationships and expectations and hitting due dates and budgets and gathering conditions and getting things scheduled, making sure people are going to be in town. So there's a lot going on. So when you're, looking for a loan officer, obviously rate is an important factor of making this decision, but it's not the factor in making this decision. And you got to have somebody that knows what they're doing. They have the relationships in place. They've been doing it for a while. They're able to look around the corner and they can foresee problems coming and hopefully avoid them. So, rate again, important, but it's not that important, especially if the loan doesn't close because your loan officer wasn't able to see something that they should have. So again, this is kind of a snapshot of everybody that's going to be working for you. So with that, we'll move on to our next slide. And that next slide is going to talk about your role in all of this as a borrower and what you can do to make things easier. What's expected of you as a borrower is more than just filling out an application and sending in a couple of pay stubs. This is a 30-day process, and we need to be sitting on the same side of the table. So as a borrower, your role is first and foremost communicate with your real estate agent up front, your expectations, your preferences, your concerns, and make sure they know what you're looking for. So you don't waste a whole bunch of time looking at houses that you're not even interested in. When that starts happening, everybody gets frustrated. So be sure to be clear about what you want, what your budget is, what you expect, what your must-haves are, what your absolutely nots are, all that kind of stuff. Your role as a borrower is to meet with a lender and obtain a pre-approval letter as early in the process as possible. There's no point in looking at houses if you have no idea how much you're approved for. I mean, you're wasting everybody's time, including your own, by doing that. So again, your role, get involved with a lender, find out your budget as early in the process as you can. A lot of realtors won't even show you a house unless you have a pre-approval letter. Some sellers won't even let you in unless you have a pre-approval letter. So it's a very important part of the process. Your role as a borrower is to provide all the required documentation in a timely manner and in its entirety. So, once you find a house, a lot of times, maybe 30, 45, 60 days have passed since you filled out that initial application. So when you find that house and you get the purchase contract signed, we're going to need updated documents, right? We're going to need updated pay stubs. We're going to need updated bank statements, asset statements, whatever it may be. We may be asked for additional documentation coming out of underwriting. So be prepared to provide that. And again, in a timely fashion and in its entirety. So when we ask for, say, for example, bank statements, and if it says page one, 1 of 7 on the bottom of that first page, and page 7 is blank. I still need page 7, as silly as it may sound. So all documents in their entirety, and certainly don't send screenshots of balances or anything like that. The underwriters aren't going to accept those. Your role as a borrower is to be available, to make decisions, be available to be flexible. I'm sorry, I said that twice. Be flexible around closing. Things start to happen really fast after you get your clear to close. So just be flexible with your time, and knowing everybody is working to get your file through the door. So if it doesn't happen, on the day that you wanted it to, and it happens the next day, just be flexible with that. This is a tricky business. Things can change quickly, and we're relying on a lot of people to get their jobs done. Sometimes it can get a little hectic. So those are your roles. That's what's expected of you as a borrower. And, if you do these things, it really will make the process go a whole lot smoother. All right. So one of your roles as a borrower, like we just talked about, is to get pre-approved. But why? Why do I need to get pre-approved? You may be saying, I know what I can afford. I know what payment I'm comfortable with. I know my credit score. Um, there's a whole lot of reasons to get pre-approved. And number one is to absolutely determine what you can afford. Just because you're comfortable with a payment doesn't mean that you can qualify for that payment. So take those steps. Get your credit pulled. Send in your income documentation. Find out exactly what you can afford. Because if you do, I can promise you will gain negotiating power with the sellers. You'll gain some traction with realtors. If you haven't taken those steps and done that legwork to find out what you can truly afford, most people aren't going to take you too seriously as a buyer. And that just saves people time all around, to be honest, going back to looking at houses that, you wouldn't be able to qualify for. If you walk around and look at them on a Sunday afternoon, with the family, that's one thing. That's only your time that you're kind of kicking around, and you're free to do what you want with that. Uh, but if you have realtors showing you around, or you're asking realtors to show you houses in price ranges that you can't afford, and now you start wasting their time. You're wasting the listing agent's time, and time is the one thing we can't get back, so we try to avoid wasting it. And lastly, there's no unwanted surprises, right? If you've sent in all your income documentation, tax returns, all that kind of stuff, your loan officer, should be able to see around the corner if there's going to be any problems. The documentation that you submitted should raise those, and those should be seen for front. Whereas if you wait to go apply for a loan after you found a house, and then you find out a whole bunch of stuff that now you can't get it, you're surprised. You wanted that house. Now you're a bit disappointed, and obviously we want to avoid that. This is a stressful enough process. Uh, One thing I do want to touch on, a couple of terms that are used interchangeably quite often, is a pre-approval and a pre-qualification. So we're going to jump in. So pre-approval or pre-qualification, which one is it, right? What's the difference? They seem to be used interchangeably, and they are. They shouldn't be, but they are. So technically, a pre-approval is an approval that's based on income and asset documentation that you as a borrower have provided to your loan officer. They've been reviewed and they've been accepted by the lender. So essentially, your debt to income ratio has been determined. And your debt to income ratio is going to be what determines how much of a loan you can qualify for. Versus a pre-qualification, typically just based on a conversation, right? Somebody will call and say, I need to get pre-qualified. I have a 720 credit score. I have $100,000 in the bank and I make X amount. So you go ahead and write a pre-qualification based on that conversation, say, and then you go shopping for a house, because people will accept a pre-qualification letter. And you go shopping, and then you make an offer, and you get back with your lender, and now you decide to submit, or now you're required to submit these documents, the W-2s, the pay stubs, bank statements, tax returns. And now all of a sudden stuff may come up. Maybe you're self-employed and you wrote everything off, or a big chunk of it off in your tax return. So while you said you made $7,000 in a month, $7,000 a month, which you very well may have, tax returns and the allowable income that we're allowed to use to qualify may reflect something around 2,000 or less. And that's really going to throw off a pre-qualification. So it's best to get these questions answered up front. Have your debt to income ratio absolutely determined, especially if it's tight, and find out exactly, what you can get pre-approved for. So if you got to choose, take the time, gather up your documents, get your pre-approval, and you'll avoid any frustrations down the road. Because believe me, as frustrated as borrowers are when that kind of stuff happens, you're not the only one. Your agent's frustrated, seller's frustrated, lender gets frustrated. So it's best to just, get it all taken care of up front. And as far as getting those documents in, what kind of stuff are you going to need? Everybody's different, depends on, job type, how you're paid, self-employed, not self-employed, all that kind of stuff. But in general, you're just going to need a quick list of documents, and we're going to go over those here on the next. All right, so the documents that you're going to need are going to be different for everybody, but we've all got the same starting point, so to speak. This is a generic checklist that everybody will be asked for. W-2s, 30 days of pay stubs, 60 days of your asset statements, obviously a sales contract. If you have rental properties, you're going to need lease information, mortgage information. If you're self-employed, they're going to dig a little bit deeper. We're going to need 2 years personal tax returns, 2 years business tax returns. If your business is filed through your personal tax returns, so if you have, say, a single member LLC, for example, that self-employment income is going to be run through your Schedule C on your 1040s. So you would just need the 2 years of personal tax returns. So depending on business structure, entity type, all that kind of stuff, it's going to determine the tax returns that we're going to need. If you're self-employed, you're going to need a year-to-date profit and loss statement. This isn't going to be used to determine your income, but it will be used to support your income. So if you're showing, declining income, for example, that's going to raise some questions that could cause some issues. So best to get all that kind of stuff figured out up front, like I said. Corporate formation docs, if you're getting into S corps and multiple owners, we're going to need everything associated with it. FHA, VA, USDA, any type of government loan, you need social security card, copy of photo ID, typically a driver's license. And then VA, you're going to have your certificate of eligibility, and then your discharge papers. Now I say this is a generic list because a lot of these items will get turned in and they will spur more questions. And the answers to those questions will trigger the requirement of additional documents. So I say everybody has the same starting point, but everybody's going to have a different ending point as far as what they need to submit in order to get the loan funded. So this is the absolute starting process. So now we got that taken care of. Let's take a look at some things that you can do to make this whole process, as simple as possible. All right, simple loan approval tips. We're going to do the do's and don'ts. We're going to start off with the do's. So do absolutely call your loan officer with any questions. Never, ever, ever make an assumption. If something pops up, you don't know the answer, call your loan officer. If they don't know the answer, they'll find the answer. But again, do not make assumptions. Provide required documents promptly. We kind of went over that. The faster you get us stuff, the faster we can get everything done. Do continue living at your current residence. Don't move in the middle of this process. absolutely continue to make any mortgage or rent payments. Don't want to have any last minute late payment show up on a credit report. Continue to use your credit as normal. Absolutely be sure to keep working at your current employer. A job change in the middle of this process can be a nightmare. So do everything in your power to avoid it. You absolutely want to stay current on your existing debts. Don't want to open any more accounts. Just make sure all your payments are staying up to date on the ones that you have. Keep good financial records, bank statements, paper trails on any kind of deposits, divorce decrees, all that kind of random stuff. If you've got all of that stuff, start gathering it up. And then again, communication with your loan officer weekly is a must. If you're working with me, I've got a system where I call everybody on every file on every Tuesday. So there is not a point in the process that my borrowers don't know what's going on, what's expected, and what's happening next. Um, so let's look at the don'ts. Those are some things that you absolutely want to do. Um, let's take a look at some things that you don't. So what don't you want to do? I mentioned this one earlier, but you absolutely don't want to take any screenshots of your bank or your asset statements. No underwriter is going to accept a screenshot of anything. Again, don't change employment. Certainly don't change your marital status during the process. You want to avoid making any major purchases, for example, cars, financing furniture for the new house, jewelry, etc. Anything you finance is going to result in a new payment. Any new payment is going to be added and included in your debt to income ratio. And if you're tight already, it could blow things up. So definitely avoid it. You definitely don't want to change bank accounts in the process. It's not a deal killer by any means, but there's a big paper trail that's going to go along with it, and it's just going to make everything take longer, to be honest with you. Along the same lines, bank accounts. Don't make any large cash deposits. Don't make any large deposits at all if they can be avoided, but especially cash deposits. The problem is they can't be traced. Cash cannot be sourced. If you have large deposits, say tax refund check, bonus check, something like that, that's acceptable. Just keep a copy of the check that was deposited and keep the paper trail, and everything will be fine. Don't close or max out any of your charge accounts. You want to keep using your credit just as normal. Don't want to take out any new loans. That includes co-signing on any new loans. And that also includes taking out any cash advances on any of your credit cards. And again, I'm trying to pound this one into your head, don't forget to communicate with your loan officer weekly. If you're working with me, that's going to be on Tuesday. Hopefully, whoever you work with has some kind of similar system where they keep you in the loop on a weekly basis. And if they don't, make sure you call them every week. All right, let's dive in to closing costs a little bit and what you can expect to pay, what's included in the cash to close at closing, any out-of-pocket costs up front. So we'll dive into what we can expect. Obviously, you're going to have lender charges that can come in the form of underwriting fees, processing fees, origination points. It can come in a variety of ways, but you can expect to see lender charges in there. For example, ours are about $1,500, and it's split up between a processing and an underwriting fee. You can also expect to pay, obviously, your appraisal fee, and this is the one cost that you're going to be required to pay up front and out of pocket. So once you do get a contract and you turn that into your lender, and they're going to start their order outs, meaning they'll start the title, appraisal, all that kind of stuff. So they will get that ordered. You can expect to see an email from the appraisal management company that will include a link to make a payment. You will see this fee disclosed on your loan estimates, And it needs to be disclosed because it is a cost of doing the loan, but it's important to remember that that number is not wrapped into the loan. You're going to have to pay that up front and out of pocket unless you make other arrangements with your lender, but 99% of the time that's going to be due up front and out of pocket. Next thing we can take a look at is you're going to have to get your title insurance. You got your title closing fees. Those are usually going to come around, say, $2,200. You got escrow setup, which is basically setting up your escrow account so you have money in that account. So when taxes and the insurance become due again, 6, 12 months down the road, you're going to have enough money in that account to pay those. So depending on what month of the year you fund and what, when the taxes are due and when your insurance is going to be due, that's going to calculate a number of reserve months that are going to be due for both your property taxes and your insurance. You also have to set up your prepaid items. So those are going to be things like paying a full year of your homeowner's insurance up front. So that will be included in closing. And another prepaid item you'll often see is per diem interest, and that's just a daily amount of interest that's due at closing, and that number will change every day depending on the date that you fund. So, for example, if you fund it on the 1st, you're going to have 30 days of prepaid interest. You fund it on the 30th, you're going to have 1 day of prepaid interest. You fund it on the 15th, you'll have 15 days. So that's kind of how that works. Then you'll have discount points. Unfortunately, this market is requiring them in a lot of situations just to get the loan done. So discount points are pretty common right now. These are not origination fees. These are not fees that go to the lender. This is just what it costs to get the rate. So you can expect to see those in a lot of cases. Transfer taxes, often paid by the sellers, is still something you'll see disclosed a lot of times on the loan estimate. You got recording fees with the county. Those are usually going to run you about $450 for recording the deed and recording the mortgage. And you'll have other third-party fees. For example, if you use, a notary, obviously you'll have to pay them for their services, things like that. Important to remember these closing costs are on top of obviously your down payment, but these are the kind of items that you can expect to see. And they're obviously going to vary on loan amount and down payment and a bunch of other things. So it's tough to give numbers, but these are the items that you can expect to see. So I just wanted to run through all that. Oh, and one more thing. I know we did say the appraisal was due up front and out of pocket. Um, if you are going to get a home inspection, that is also something that you will pay for up front, out of pocket, outside of closing. So those two items are the ones you can expect to pay for yourself. Everything else can be paid at closing. So that kind of covers the closing costs, and we'll move on to the next section. And the perfect transition, I suppose, home inspection versus home appraisal. Again, both items you can expect to pay for out of pocket up front, but there are some differences and oftentimes some confusion around these items. So let's just dive into both of them real quick. The whole purpose of the home inspection is it will determine the property's overall condition. They're going to get under the house, they're going to get in the rafters, they're going to look at every single little thing. Your appraisal, on the other hand, it determines your property value, which is heavily weighted to the comparable sales in your neighborhood. So the condition of your property doesn't have a whole lot to do, with the value of it. It'll have something to do with the saleability, obviously, but your appraisal is going to be heavily weighted and heavily determined on comparable sales, recent sales in the same neighborhood, same property type, same kind of architectural design and that kind of stuff. So home inspection determines condition, appraisal determines value. As far as the inspection is concerned, it's not an item that is actually required by the lender. It is totally up to you if you want to get a home inspection or not. 6, 8 months ago in the flaming hot market, a lot of people were waiving inspections just to make their offer stronger so the seller didn't have anything to worry about as far as buyers coming back and asking for repairs. Those days, I think, have gone by, and I think that's a good thing. I don't think waiving inspections on homes is the greatest idea. It could come back to bite you, but then again, it could be totally fine. So that is an individual decision. And again, the property or the home inspection is not something that's going to be required by the lender. Unless if you get a down payment assistance loan, if you do like the state bond program, they will require a paid receipt for the home inspection just so they know that you got one. However, they do not require a copy of it. Costs for home inspections, they're going to range between 250, $400. And again, that's something you'll have to pay for out of pocket. Appraisals, you're going to, depending on the property type, if it's your run of the mill house, you're going to run around probably 800 to $1,000 in this area. If it's a unique property or a property it's difficult to find comparable sales on it because it's unique, you can expect, that price to go up. Same thing with distance. If you've got a property that's out in, Waterville and the appraisers in Chelan, they're gonna charge you a trip fee for that. So the price kind of goes up on distance, complexity, availability of comps, that kind of stuff. One thing I skipped over there on the appraisal, the appraisal is obviously not optional. It is a required report. It's required by the lender. We will order it through the appraisal management company, unless in the off chance we get an appraisal waiver in our automated underwriting findings, then we can skip that part. But that's not something I've run into a whole bunch, especially on purchases. It's more common on refinances. Home inspection, you get to choose your inspector. You and your agent can, use their relationships to find somebody to get that done for you. The appraisal, on the other hand, that's ordered by the lender through an appraisal management company, and that appraiser is selected by them. An order will go out, and then it'll get picked up by an appraiser. They will give us a cost estimate and a estimated due date, and then we will either say yes, that's good, or counter offer with a lower price or a shorter turn time, or whatever the case may be. Your home inspections are going to be typically delivered 24 to 48 hours after that inspection is done. So turnaround is usually pretty quick. The appraisal, on the other hand, depending on how crazy busy the market is, can take a little bit. Right now, obviously, rates are high. Things are a little bit slower. Appraisers aren't quite as busy. So those are coming back a lot quicker. 6, 8 months ago, if I wanted an appraisal in Malaga, I would be waiting 4, 5, 6 weeks. So that can be the hang up in a busy market. But again, today, not as big an issue as far as a turn time. They'll give you a due date, and then they'll usually have it back to you by that due date. And if they don't, they're usually pretty good about communicating why and new expectations as far as when that appraisal can come in. So that covers the home inspection versus the home appraisal. Next thing I want to dive into is your mortgage payment. What makes up your mortgage payment? PITIA, right? So that's principal, interest, taxes, insurance, and then the A, I usually put, in parentheses, if you will, association dues. Obviously not something you're going to pay on every property. More common in PUDs and condos, townhouses, that kind of stuff. So you got your principal, your principal payment, and that's just the repayment of the money, the amount of the money that you borrowed, and that principal amount increases over time. Most of your payment in the first couple of years, handful of years, is going to be going towards interest, and this is the percentage charged for borrowing the money. Obviously, on top of that, in most cases, unless you have waived your escrows, you're going to have your taxes and your insurance in there as well. So obviously your taxes are determined by the city, the county, whoever, and it's based on the property value. Insurance is obviously just your homeowner's insurance and possibly mortgage insurance if you put less than 20% down or if you're in an FHA loan. So that's going to fall under that insurance category as well. So those 5 items altogether is what's going to make up your mortgage payment. And that next slide is going to talk about your role in all of this as a borrower and what you can do to make things easier. What's expected of you as a borrower is more than just filling out an application and sending in a couple of pay stubs. This is a 30-day process, and we need to be sitting on the same side of the table. So as a borrower, your role is first and foremost communicate with your real estate agent up front, your expectations, your preferences, your concerns, and make sure they know what you're looking for. So you don't waste a whole bunch of time looking at houses that you're not even interested in. When that starts happening, everybody gets frustrated. So be sure to be clear about what you want, what your budget is, what you expect, what your must-haves are, what your absolutely nots are, all that kind of stuff. Your role as a borrower is to meet with a lender and obtain a pre-approval letter as early in the process as possible. There's no point in looking at houses if you have no idea how much you're approved for. I mean, you're wasting everybody's time, including your own, by doing that. So again, your role, get involved with a lender, find out your budget as early in the process as you can. A lot of realtors won't even show you a house unless you have a pre-approval letter. Um, some sellers won't even let you in unless you have a pre-approval letter. So it's a very important part of the process. Your role as a borrower is to provide all the required documentation in a timely manner and in its entirety. So, once you find a house, a lot of times, maybe 30, 45, 60 days have passed since you filled out that initial application. So when you find that house and you get the purchase contract signed, we're going to need updated documents, right? We're going to need updated pay stubs. We're going to need updated bank statements, asset statements, whatever it may be. We may be asked for additional documentation coming out of underwriting. So be prepared to provide that. And again, in a timely fashion and in its entirety. So when we ask for, say, for example, bank statements, and if it says page one, 1 of 7 on the bottom of that first page, and page 7 is blank, I still need page 7, as silly as it may sound. So all documents in their entirety, and certainly don't send screenshots of balances or anything like that. The underwriters aren't going to accept those. Your role as a borrower is to be available, to make decisions, be available to be flexible. I'm sorry, I said that twice. Be flexible around closing. Things start to happen really fast after you get your clear to close. So just be flexible with your time and knowing everybody is working to get your file through the door. So if it doesn't happen, on the day that you wanted it to, and it happens the next day, just be flexible with that. This is a tricky business. Things can change quickly, and we're relying on a lot of people to get their jobs done. Sometimes it can get a little hectic. So those are your roles. That's what's expected of you as a borrower. And, if you do these things, it really will make the process go a whole lot smoother. So let's dive into mortgage insurance a little bit. There are two types of mortgage insurance. First is MIP/UFMIP. A lot of acronyms in this business, so I will kind of go through this one. MIP is mortgage insurance premium. UFMIP is upfront mortgage insurance premium. So these are insurance premiums that are insurance for government loans. They've got an upfront and a monthly cost. The upfront MIP is typically on an FHA loan going to be 1.75 or 2.25% of the loan amount, depending on the loan and the situation. And that amount can be financed into the loan. So that's not something you're going to have to come up with, at closing. And then you have your mortgage insurance premium, which is the monthly mortgage insurance. So you're going to have the upfront, this added on to the loan amount, and then you're going to pay that monthly amount as well on an FHA loan. Then on conventional loans, you have what is called PMI, which is just private mortgage insurance. Private mortgage insurance has no upfront premiums. Again, it's insurance for conventional loans, and they do offer premium payment options. So you can do a single premium mortgage insurance, which is basically you pay it all up front and at closing, and you won't have that monthly amount um, tacked onto your mortgage payment. You can skip paying it all up front and just pay it monthly, or you can skip both of that and you can build it into the rate. So you can take a little bit higher rate and have the lender pay the mortgage insurance. So it's whatever situation works best for you. 90% of the time, people are going to do the monthly mortgage insurance on the PMI instead of paying it all up front or taking a higher rate. So, how do you get rid of mortgage insurance? When does it fall off? So let's take a look at eliminating mortgage insurance on conventional loans. So you can skip it altogether. You can skip mortgage insurance altogether if you put down a 20% down payment. You'll never have to worry about it on a conventional loan. If you put less than 20% down, that mortgage insurance is going to stay in place until you get to 78% of your loan to value. At that point, it will automatically fall off. You can request it to be removed once that loan to value is at 80%. And the way they calculate that is off the original purchase price. So if there's been any equity growth, that's a conversation you'll have with your lender, and maybe they send an appraiser out and recalculate that loan to value, and then you can get it removed that way. Eliminating M on FHA loans, it's pretty cut and dry. If you've put less than 10% down, which most people do because the minimum down payment on a FHA loan is 3.5%. If you put the 3.5% down, you can expect that mortgage insurance payment to stay in place for the life of the loan. So until you sell or until you refinance out of it. And then if you put more than 10%, 10% or more down, that MI payment is going to be there for 11 years and it will fall off after that. Or again, if you sell or refinance, obviously it goes away. Okay, so let's take a look at the loan programs that are available out there to help get you in your house. There are a bunch of them, so we're going to just hit the high level stuff and we can dive into the specifics if you like. Fire away the questions, but starting at the top here, most common is going to be your conventional product. Those are your Fannie Mae, Freddie Mac, insured loans that most people will get approved for. You've also got government loans. These are the FHA, VA, USDA programs that are really good for first-time home buyers. They've got flexible debt-to-income requirements. They got lower down payments. USDA and VA, they have 100% financing. They've got some income limitations when it comes to the USDA program, so it can get a little tough to fit in the box, if you will, and check off all those qualifying factors. But if you can, there's some great government programs in there. Obviously, the most popular is the FHA program. After that, you've got non-conforming jumbo loans, and basically those are loans with loan amounts that exceed the loan limit for whatever county that loan's getting originated in. So say it's 647,200, right? If you've got a loan that's 650,000, 700,000, you're looking at a jumbo non-conforming product. And we have, I think, 17 of these programs. So really depends on what your situation is, what the numbers look like, and then we can kind of scroll through our programs and find out, which one makes the most sense for you. Also got non-QM loan options. So QM means qualifying mortgage. So it's a non-qualifying mortgage. And these programs are stuff that have more flexible income documentation requirements, things like bank statements, 1099s, asset depletion. So there's a lot of options for investors, high net worth borrowers, self-employed borrowers. these are going to be the bucket of loans that are going to be, pretty valuable to that group of people. Also got a debt service coverage ratio loan for investors that, as long as the house cash flows against the mortgage payment, we don't even need to enter income or anything like that. So that's a pretty cool program. And then you got the state bond loans, the DPA down payment assistance loans. And those are all done, in tandem with the Washington State Housing Finance Commission. So diving in. All right. And that is that. Looks like we made it all the way through to the end. I appreciate you guys that are still here. I'm sure we've lost a handful of you. It was a long hour. So I do appreciate everybody spending some time with me. And obviously, if anybody has questions, comments, concerns, or otherwise, I would love to hear from you. All my information here is on the screen, and you'll have it in the handout as well. So, again, thank you everybody, and I look forward to hearing from you in the future.